Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds to reach financial freedom as soon as possible. And welcome to episode 36 in my monthly series, where I'll give you a quick update on the overall stock market in the past month and review some of the most popular high-yield income-oriented funds on both the Canadian and the American stock market to see how they're doing, if there's any news, and see which ones stand out as good buys this month. So if you're new to the channel, welcome. This channel and my investing strategy focuses on a long-term buy and hold income-oriented strategy. So the primary objective of the strategy is to generate relatively safe, consistent, and high passive income forever. And one important factor of my strategy is to consistently invest over time. If you do, you could capture what's undervalued in the stock market, dollar cost average, and keep growing your income stream over time, ultimately fighting inflation. So I do not invest in any single stocks or single companies anymore, with minor exceptions. So all the picks will be funds, ETFs, or closed-end funds that are really designed to provide high monthly yield and passive income. So they're essentially income-oriented, not growth-oriented. So most, if not all, my returns come from the income. And a lot of these funds have income enhancing strategies like covered calls, mostly covered calls, and leverage, and sometimes both. So remember that I am not against the more mainstream growth or dividend styles of investing. These strategies all work well a long term. But those are really designed more for total return, whereas my strategy is really designed to maximize income. So without further ado, let's check out some of the best income-oriented funds on both the Canadian and American stock markets. All right, everyone, let's quickly check how the Canadian market has done in the last month. It's actually hasn't been so bad. It's pretty much flat or broken even. You could see the dip here in mid-February, but there was a nice sharp rally. I am filming this on March the 4th, so there was a rally on Friday. Same type of deal for the S&P 500, the overall US market. So mid-February took a dip and then a sharp rally at the end of or beginning of March. So now let's take a look at the top high yield funds on the Canadian market first. So of course we're going to start with our big five, right? Our big five core positions here. So we'll start with HYLD, which now has a yield of over 14%, which is pretty crazy. And stay tuned for a 1 year later Q&A video with Rob Wetzel and Patrick Somerville, the two senior guys at Hamilton ETFs. We're going to talk all about H-Yield, guys. We're going to discuss all the concerns that they get and that I get as well. Dividend sustainability, stock price going down, on the underperformance related to VSP or the S&P 500. We could kind of see it here. So after a year, the numbers are out, and HYLD did underperform or is underperforming VSP by a little bit here, by about 4%, 4.5%, or something like that now. So stay tuned for that video, guys. A must watch if you are a holder of H-Yield or HYLD. But HYLD is still one of my top positions. It's my biggest holding. It's getting absolutely huge at over $400 million in AUM. So we're going to talk a lot about that in an upcoming video. Has not missed a dividend. So HYLD, definitely a good pickup. Of course, is a very, very high yield right now, but everything else as well. So even HDIV, which recently increased their monthly distribution from 12.5 cents to 13.5 cents, is doing really well and is, has taken a dip recently. So the yield is over 10%. So it did recently add HMAX to the mix. You see that here. So they will be selling off ZWB for HMAX. I know there's 1.6% left, but they're basically going to swap it all into HMAX. So I really like this idea because now with HDIV, you have both HMAX and HFIN. So you have maximum income, maximum growth of the top Canadian financials, which is, they counterbalance each other really, really well. And of course, you have a lot of energy, gold, and utilities because, this is more sector mix to track the Canadian market or the S&P TSX 60. But I also like the fact that they added HHL and HTA to give you some of that healthcare and tech exposure that Canada has none of. So definitely a good time to pick some up as well to average down. You have HDIF, of course. This is the Harvest all-in-one where they put their 6 popular covered call ETFs in here. It's doing extremely well, as also doing very well, almost at 300 million AUM. Very nice yield as well, a little over 10%. So a great time to average down these big all-in-one core positions if you have them like me, and that's what I'm doing. BMAX is being BMAX, completely consistent, 10-cent a month dividend. And right now, out of the four, it is the lowest yielding one at about 9.5%. But of course, this one is a little bit more conservative because it's 30% fixed income and 70% equity, whereas the first three that we looked at are 100% equity. And of course, you have EIT, which is a closed-end fund, and right now it is trading at a small discount, but it usually is. And this fund has been doing phenomenal. It definitely has the lowest yield out of the five because if the price goes up and the dividend doesn't change, the yield is going to be down when you purchase it. So you always take a look at the top 25 stocks in here. These are all, dividend growth value stocks. I would say there's no technology stocks in here. If you look at the breakdown, it's pretty much financials, healthcare, energy, materials are the top four sectors. No technology whatsoever. And it is mostly Canadian, a lot of US, and a tiny bit in international equity. So those are the top five. Top five, I meant the big five, I feel are, core positions. Now let's take a look at some split share funds and closed-end funds. So on the Brompton side, does anything really stand out to me this month? Yes, LBS in particular. So if you see the closing price here, and this is of course March 2nd, which is doesn't take into account Friday's prices, but 905 is the stock price. The NAV is 831. So this is trading under 10% premium, which is a really rare thing for LBS. So a nice 13% yield, a little over 13%, trading at a very small premium. So how do you calculate that? You always do the stock price or the market price divided by the NAV minus 1 times 100. So you see that it's only trading at an 8.9% premium. So a great time to pick up some LBS, in my opinion. LCS, which is the one that just holds the insurance companies, which I stay away from because it misses a lot of dividends. But hey, insurance companies have done really well, and this one's actually trading at a discount. It's worth $634. You could buy it for $616 or approximately that. Keep in mind, these are March 2nd prices here. Really nice high yield, the highest yield out of all of them right now, 14.61. But just remember, you're only getting access to 4 companies, not 10 like LBS. But hey, if you really feel strongly about life insurance companies going forward, if interest rates remain high, this could be a good bet to get really nice yield. Besides that, everything else is trading at a too much of a big premium, in my opinion. DGS has missed the dividend. It's under $15 unit NAV right now, so we'll see what happens next month. Moving on to Middlefield. So as we know, they have 2 split share funds, ENS and RS. RS by far is really standing out to me this month as a fantastic pickup. It's trading at a much smaller premium than usual. So if you go to do the closing stock price of 1536 divided by 1426 minus 1 times 100, so it's only trading at a 7.71% premium. So really good time to pick up some real estate exposure, really good time to pick up some RS guys. So RS and LBS are really the split share funds that are standing out to me this month for sure. And maybe LCS if I personally will stay away from this one. For Quadravest, DFN is trading at a big premium right now. So worth $591. And it's trading at 780. FTN about 15% premium, so not so bad. Still kind of attractive. I think not as attractive as LBS. It's worth about 847, and you could pick some up for 977. So then there's BK as well, trading at a big premium, worth 1110. And you need to pay $13.61 to buy it. So that is pretty much the split share funds. You have Bitcoin and Ether, which are still very down. Which are a little bit disappointing with the latest distributions because they've remained the same. I thought maybe they would get a little bit higher because the price of Bitcoin and Ether has picked up a little bit in early 2023, but it seems like it's dipping and going back down again. So I don't really know what the deal is here. I'm assuming they're writing less covered calls and generating less premiums because they feel there's more upside potential. That would be my explanation. But relatively stable distributions of the last 3-4 months, the same ones, unfortunately not going up. There is Purpose also has a newer ETF or style of ETF where it's just a single company. They have 5 of them. Tesla is one of them. You guys know that I picked up TSLA. That's Tesla shares, Tesla stock symbol. YTSL. That is the stock symbol of this ETF here. So they hold Tesla shares, 25% leverage, and out of the money covered calls on 50% of the portfolio. So I was lucky enough to buy this at the beginning before the Tesla rally. I got this when Tesla was down. I think my average price is like $14, but now it's over $20. But 3 stable distributions. So very interesting, but of course I would only make these as secondary positions, and they have other ones. They have an Apple one, Berkshire, Google, Amazon, and another one, I believe. There is HMAX. So HMAX, just to let you know, in case you missed the video, is a brand new ETF from Hamilton, which has the top 10 financial companies, no leverage, but very aggressive at the money covered calls on 50% of the portfolio. So you're giving up more upside for a lot more income. Very impressive. Very close to 14% yield here if you want Canadian financial. So this is a good alternative, let's say, to LBS. It has almost the same identical companies, but you would get no leverage, but in an ETF format. But just remember, guys, that HMAX is now a big position in HDIV. So if you're not really too comfortable in getting HMAX directly, you could always invest more in HDIV, which has HMAX as a big position here. And that's definitely probably one of the reasons why they were able to do a dividend increase. Besides that, moving on, there's some great tech options. So tech is still undervalued in my opinion, everyone. This is normal. Tech companies or growth stocks will underperform, will go down hard when interest rates go up. So you have a few options. I mentioned them last month. I'll mention them again. QQCC, very interesting option from Horizons ETFs. Over 13% yield right now. This is basically the NASDAQ with covered calls, but they are out of the money covered calls and not on the whole portfolio. So very incredible that they're able to generate such high distributions. And another thing I found interesting is that the distributions for the Horizons ETFs, covered call ETFs, have stabilized recently. So I am going to be talking to the Horizons covered call manager again, Mr. Nick. He was really awesome, and I'll ask him about that. But you see that very interesting that typically they're always different, but now QQCC and even the other ones have remained fairly stable for the last 3 months. So I'm curious to know why that is. So QQCC, definitely a great option if you want a lot of tech exposure. It's about like 50% tech exposure here. Yeah, 56% technology. So a lot of technology companies. For pure option, you have HTAE, which is the Harvest technology covered call ETF with 25% leverage. This is pure technology, 11.53% yield. And then you have TXF, which is still has really nice yield of just under 13%. And so that's pretty much it on the Canadian market overview. I think there's a lot of great options. You could dollar cost average your big 4 here, whichever one you're down the most on. Obviously HYLD is very attractive at over 14% yield. In terms of split share funds, the big winner has to probably be RS, trading at a small premium. Great time to buy real estate, guys, if you want to pick some up. LBS, a good bet too. HMAX if you want it in an ETF format. And again, don't forget that HMAX is in HDIV. Another quick announcement is that Harvest is launching 2 new covered call ETFs. They're launching a covered call version of their travel ETF, travel and leisure ETF. So that's coming out soon. And they also launched a very similar fund to HDIV. I think it's going to have the exact same thing as HDIV without the leverage. So if ever you're interested in these all-in-ones, but you're not comfortable with a 25% leverage, well, guess what? There's going to be a non-leveraged version of HDIV coming out soon, which is going to be called HRIF. So that's basically it on the Canadian side. Now let's check it out on the American side. All right, we'll start with the big 5 as usual. These are the top 5 covered call ETFs on the US market, in my opinion. Of course, I'm talking about Q Yield, R Yield, X Yield, JEPI, and JEPQ. So there's not really been any surprises. Q Yield is doing exactly what it's supposed to be doing. The distributions have been exactly what they're expected to be. So they will fluctuate, go up and down based on the NAV. So if QYLD starts going up in price, they will go up. QYLD goes down in price, they will go down as well. So that's what's been happening with QYLD, RYLD, XYLD. Keep in mind, these are really aggressive covered call ETFs that they're writing calls on the whole portfolio. But they are not giving out income, the whole premium out. So I'm probably going to make a new video on this because, Q Yield has been getting a really bad rap lately. I'm actually trying to secure with the help of my good friend Rob Wessel, an interview, a Q&A with Global X, so we could discuss Q yield, R yield, and X yield in details. We're working hard to try to get that access, but they're doing exactly what they should be doing. Of course, QYLD is still the one that's the most attractive in terms of stock price because it's the Nasdaq, and the Nasdaq is suffering more than the S&P 500, for example. You got JEPI. JEPI's doing fine, completely great. And the distributions, the recent one came out for March, a little bit lower. And this is the thing that you're going to have to expect with JEPI and JEPQ. Same deal, just a tad lower. Once volatility goes down, I expect that the distributions for JEPQ and JEPI go down a little bit. So that's it for the big five. All of them are great pickups all the time because they're just index-based ETFs. So it's just up to you to figure out which one is best for you. Out of the five, if you ask me which one is the most conservative, it's definitely going to be JEPI. But JEPQ is also a fairly conservative way to get access to the Nasdaq as well, in case you think Q yield is too aggressive, or in case you think XYLD is too aggressive, could always get JEPI and JEPQ. The numbers don't lie; they're doing very popular. ETHY, another one of my personal favorites. Very unique strategy. They short the VIX to get those big premiums, and they buy a monthly, way out of the money covered call on the VIX in case it spikes. So really awesome. It's still at 17% yield. It is growing fairly rapidly as well. 175 million here. It's been out for over a year, and now they are targeting 32-cent monthly distribution. So very, very consistent. Another three ETFs that I really like on the US side is these fixed income iShares ETFs that do covered calls on TLT, which is the government 20-year treasury bond, LQD, which is investment grade corporate bonds. So corporate bonds of really high, good quality companies. And then HYGW, which does cover calls on HYG, which is your high yield corporate bonds. So not investment grade like LQD, but just regular high yield corporate bonds. I personally own HYGW. I think it's awesome. All of these have all started at $40. And TLTW is at 33, LQDW at 33.63, and check it out, HYGW, the one that's supposed to be more risky with the higher fee, is at 36.50. Is actually doing the best. However, you can expect varying distributions. All three of them have much lower distribution for the last month, so that's just something to take in consideration. But I feel like these big five here are great for your equity exposure in America. This is kind of an alternative style ETF, but if you want to throw some fixed income, now we have an opportunity to get some covered call, some high yield covered call income off these fixed income ETFs. Moving on to closed-end funds now. So CLM is, of course, a very popular one. It's at 20.54% premium, so I don't think it's a good purchase right now. The premium is too big. Only when it gets under 15 and especially under 10 is when I feel closed-end funds are more interesting. But I just wanted to advise you that the annual offering, rights offering, might be coming for CLM, which could drop the stock price significantly, resulting in a great buying opportunity. So just keep that in mind, guys. If we look at last year's, they announced it in April of 2022. So we could be a month or 6 weeks away from the 2023 rights offering. Of course, I don't know if they're going to actually do one for 2023, but they typically do one every year, I believe. So CLM might be a good pickup in the next month or two if the price drops and the premium becomes much smaller, which it typically does. For your overall closed-end fund or all-in-one option, you have YYY, which is an ETF that holds about 45 closed-end funds. Their latest distributions was released. It's the same one as, it's 12 cents, I believe. Yeah. Let me just double check here. Yeah, it's still 12 cents. So this is a great way to just, instead of picking and choosing a closed-end fund, you can just get 45 of in one ETF here. Of course, you know that one of my favorite options, this is what I invest in, is RIV. So RIV is a closed-end fund that holds multiple closed-end funds, and these guys are opportunistic. They try to find the ones that are trading at discount. So when it comes to YYY and RIV, by the way, guys, the key, in my opinion, is always to figure out, which is, I'm going to show you how to do it in a second, the overall closed-end fund discount rate. So if you scroll down here, you actually see it here. So the average closed-end fund premium, the discount is minus 5.70%. So it means that on average, out of the 45 closed-end funds in this ETF, on average, they're getting, or they're invested in the ones that have about 5.70% discount. So that's what you really want, and this is why I think this is so convenient, because instead of finding the discounted ones yourself, these guys do it for you. But check it out with Riv. Not only is Riv trading at a 5.19% discount, it's worth $12.54, but you could buy it for less than that. But if you open the fact sheet, their portfolio, the discount is actually higher than YYY's. The average discount of their closed-end fund portfolio is 13.8% discount. If you actually look at the top two holdings here, 12.4% of the fund is in these two BlackRock closed-end funds, and they're both trading at about 15-20% discounts. I actually looked it up. So yeah, Riv is definitely one of my favorite options. I hold it in my wife's RSP account, and it's on drip, which I'm happy about because it's just buying more cheap discounted shares. And OPP, guys, I know I got rid of it in my RSP, but it seems really attractive now because it's trading at a 12.38% discount. So I'm keeping my eye on this. I'm considering buying it back. So this is more, compared to Riv, it has even more fixed income. There's a lot of MBS or mortgage REITs in here. Mortgage REITs have taken a tumble in the last couple of weeks, so this is why OPP might be a great opportunity. I'm going to keep my eye on it. Then, of course, you have CEFD, which is the highest risk all-in-one closed-end fund solution. CEFD, this is what I own in my RSP, and this is just an index that tracks over 100 closed-end funds. But the key and special thing about this one is that they use 50% leverage, so it's very, very highly leveraged. So that's it for the American stock market. Overall, everything, there's nothing really that jumps out to me. I think everyone is doing their job, basically. SVOL, always impressive. Everyone is fine. Everything is doing their job. And some special news. So there's these crazy yield max ETFs that have come out with 50 to 60% yields, guys. They have one for ARK. So what they do is they own ARK, Cathie Wood's ARK ETF, and then they write covered calls on it, very aggressive covered calls, but it's called the synthetic covered call strategy. They have one for Tesla as well. And these, if you look at the Tesla one, the only two distributions have come out, but they've been really, really high, and it's basically translating to 60% yield, guys. So I have great news. I am coming out with a video to review all of these, the yield max ETFs, because get ready. These are only 2 that are out, but there's a total of 15. So there's another 13 that are coming out. And I have had the pleasure, I had just did an interview and spoke with this guy, Mr. Jay Pestricelli, very kind enough to come on the channel and talk in depth about these ETFs. And I grill him on the questions. He's the guy from Zega who's actually managing the fund or writing the options. So whenever I interview someone, it's really the guy writing the options I want to talk to, because this is a pure options strategy. As we know, Tesla, ARK, there's no dividends, right? So it's all about those option premiums. So how do they sustain a 50 to 60% yield, which is insane? Well, stay tuned for that video, guys. It's coming up in the next couple of weeks or a month. Can't wait for you guys to see that. So there it is. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z, because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.